Hello everyone and welcome to this new video where I will explain to you my strategy for 2025 when it comes to my investments. This year there is a little bit of changes because I wanted to do an analysis on my portfolio to understand its efficiency and how I could improve it. The changes are quite a lot, but they are not that big. But we will go through the analysis that I did, the calculations that I carried out, and then I will explain to you how, on a practical level, I will change my portfolio. So let's dive right into this video. By the way, if you missed the 2024 review video, I will link it down in the description. So if you want to check it out, go check it out. There you will see a little bit how my expenses went for 2024 and how we closed 2024. But without further ado, let's just dive into it. This is the spreadsheet. Don't get scary. Now I will go through the spreadsheet and I will explain to you how it works. You can find this spreadsheet in the description. I will give it to you to download completely for free, so you can just access it and download it and have fun with it. I don't know how helpful this could be for you because the data that it's in here, it's for me, it's for my portfolio, but I guess you can use it as a template to then analyze your portfolio. So, first of all, what did I want to get out of this analysis? What I wanted to get out of this analysis is to understand what's the efficiency, the mathematical efficiency of my portfolio. This is not to understand how I could, what I could invest in. I already know that I wanted to keep the investment instruments that I have and invest more or less in what I already invest in now. I wanted to make my portfolio just a little bit more efficient. What does that mean on a technical basis? It simply means that I want to increase my gains, my return, the return of the average return of my portfolio. At the same time, I want to decrease the risk. I know it's counterintuitive because we always say that for more return, you need more risk, but that's not actually the case. If you studied a little bit of finance, you will know something that it's called the efficient frontier, and that's simply a line that's drawn through all of the portfolios that are considered to be efficient. And to consider a portfolio efficient, it has to be the portfolio with the highest return to risk ratio. We will then go through this graph. You will see it for my portfolio. You can do a similar graph for any type of portfolio by combining different instruments with different weights. Okay, so what did I actually do in order to achieve this? First of all, I had to download the indices. I downloaded the indices from the MSCI website. They do provide historical prices for the indices, and that's awesome. They mainly provide them in USD, in the sense that they do also provide them in other currencies, but sometimes they are not that old. The oldest that you can find are in US dollars, and mainly almost all of them start from 1998. So that's when I started to download the data. I then transformed this data into francs by using the USD to francs conversion ratio that I downloaded from investing.com. If I remember, yeah, investing.com. So I downloaded that data. I translated the USD indices into francs, and that's what you see here. And then I just plotted them. So this is the USD franc rate, and here you can see all the indices. I just plotted them to see if the data was useful in the sense that there were no errors. Be careful. I downloaded the net indices, those that include the dividends and also take away the taxes that you have to pay, the withholding taxes, basically. I plotted the prices in US dollars and I plotted them also in francs. Good. Then, what did I do with those information? So those are basic informations that I think you understand. It's just historical prices for every date. For every date here, you know, there is a price for all the indices. These are the indices. The indices are Swiss large caps, World X US small cap, emerging markets, Swiss small and mid cap, Europe, Pacific without Japan, USA small cap, and USA investment market index. Then in this sheet, what I did is to basically calculate my in my the return of my portfolio throughout the years as it is now with the allocation that I have now. To calculate that, I took 10-year windows and I slided those windows by 1 month each time. So if I go here, you will see this is an investment that starts in January 1999 or at the end of December 1998 of 10,000 francs. It doesn't matter what I put here. I put 10,000 francs just so the numbers are a bit bigger and easier to see. And then I went down with this investment for 10 years. That's it. This is the 10th year. And I rebalanced my investment each month. So each month, this investment is rebalanced. And at the end of the 10-year period, I have the value of my investment. Then I started 1 month later. This is February 1999. I started again with 10,000 francs. I rebalanced each month, and then I have the value after 10 years. And then I did another month and another month and another month until I didn't have any more data. Then I calculated the average return, average yearly return for all of these investments. And that's basically here. So this is it. Um, Now, I should also mention, I did this for the portfolio that I have right now, and I did that for the portfolio that I would like to have in 2025. These are the weights, by the way, of the indices, and you can see them also here. This is the weights that I have right now. These are the weights that I would like to have in 2025. In this statistics spreadsheet, you can see that all those data a little bit more coincides. This is the first iteration of this investment, the first investment starting January 1999, ending January or ending December 2008. Capital start for the portfolio that I have right now, 10,000 francs. Capital start of the portfolio that I have, capital end, sorry, of the portfolio that I have right now, 9,389. As you can see, it's the same as this one right there. And that with that, I calculated the annual return with this formula. You can also calculate it without the formula from Excel. I did the same for the modified portfolio, start, end, and then the return. And as you can see here, I have a bunch of portfolios. Not a lot, only 192. It's not a lot of data, I know. All right, with this data, I managed to calculate these statistical results, basically. Um, the average, the median, the standard deviation, the minimum return, the maximum return, and what I call the modified Sharpe ratio. Modified simply because it doesn't take into account the risk-free rate. It was too complicated to take it into account. I just didn't want to take it into account. This average yearly return is an average yearly return for a portfolio that lasts 10 years, for an investment that lasts 10 years. Yeah. And this standard deviation is a standard deviation of these averages. This is not the volatility of the portfolio daily, or monthly, yearly. This is the volatility of the average yearly return for an investment of 10 years. Yeah? All right. I hope you can understand that because it's very important. Very, very important because a lot of people look at the volatility daily, monthly, weekly, or yearly, but that's yearly I could understand it, but actually you need to look the at the look you need to look at the volatility, sorry, for I would say at least 10 years or 5 years, 5 to 10 years, because that's how long you expect your portfolio to be able to generate some gains. Yeah. Okay. So I calculated these statistical data, these statistical results for the portfolio that I have right now and the portfolio that I would want to have in 2025 for the entire period. That means from 1998 to 2024. Then I did the same, but up to start of 2006. And then I divided that and then I did another one from 2006 to 2024. Why did I do that? We can maybe see it here. Yeah. This is a graph that shows the performance, the average yearly return of the portfolio if you would have started your investment in 1998 and kept it for 10 years. For example, here it's 1.36%. Yeah, for the modified portfolio. So if I go here, 1.36%. Yeah, it's just that number. All right. And I decided to divide it about here simply because I kind of see two periods. One period where the returns are fairly low, and one period where the returns are fairly high. This is also one period where we are getting into the internet bubble and going out of the internet bubble. And this one is the period where we are getting into the into the mortgage bubble, mortgage crisis, sorry, and then out of the mortgage crisis. So that's why I wanted to take those periods separately. In addition to that, this period here, so the second period, is more recent and in my view, a little bit more representative of what could potentially be what it is, the future, let's say. This is not a predictive analysis. I'm not doing any type of predictions. I'm not a magician. What I'm trying to do is just give a little bit more relevance to what it's newer, the newest information, and a little bit less relevance to what it's the uh, oldest information. In addition to this, I found out that it's pretty easy to beat the older statistics, and it's a little bit harder to beat the statistics from 2006, simply because the big techs grew most tremendously in the last years. And all of that is reflected into high averages, as you can see, yeah, high averages, and also small volatility. And that's why I want to give more relevance to that data, because again, if I can beat, let's say, this data with my analysis, then I'm more comfortable in saying, okay, uh, I'm not going out of reality, because if I would beat this data, well, of course, as you can see, it's pretty easy to beat it. Yeah. So I don't want to overestimate how better my portfolio is in comparison it will be into 2025 in comparison to what it is already now. Yeah, that's basically the thought process that went into it. And those gave rise to those two weights, 30% for the first period and 70% for the second period. Honestly, I just took these values randomly. I didn't think too much about it. So at the end of the day, everything that I do here is wrong anyways, because the future cannot be predicted. So I might as well just throw in two numbers that I find beautiful. Okay, good. Then on this part, what did I do? On this part, what I did is doing first of all a simulation to take out all these random numbers. These are random weights that I gave to the different indices in the portfolio. There are some borders to the weights. I don't remember actually what were the borders. I think it's 0 to 5% for the Swiss index. I think here it should be between 10 and 20. I think here it should be about 5 to 20. I think here it's 0 to 5 and so on and so on. That's why you see always that the US is around 20%, 10 times, 33 at times, but around that mark. And here also it's always around that same number and so on and so on. So they are not completely random. I gave the 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 the, the I gave Excel, the simulator. I did this simulation with Excel, by the way, some parameters to work with, because you can do a lot of analysis that you want, but at the end of the day, I know what I want in my portfolio. I just want to tweak it a little bit to make it a little bit more efficient. That's why I said the changes are, in the sense, quite a lot, but they are not that big, because I still stayed in what I believe is right. All right. So I ran all of these numbers, all of these different weights, and I tested all of the portfolios and so on and so on. And then I found what could be 3 portfolios that I like. And from there, I studied them. I decided how much I really wanted to allocate, what makes my portfolio better, what makes my portfolio worse. It was quite a long analysis. It took a lot of hours, a lot of try and error, also because I needed to translate these percentages into money that I wanted to allocate in these indices, sorry, in these ETFs, and then come back to this and then redo the calculations and so on and so on. So it was not that easy, but yeah, I did it. At the end of the day, what came out of it is this allocation here. 3% into Swiss large caps, 0% in well, it's not really 0% in the world, simply because I decided to split world into separate ETFs, but I actually do have a world ETF. Anyways, 16% into world ex-US small cap, emergency markets 12.5%, 5% into Swiss small and mid cap, 8% into Europe, 11% into Pacific without Japan, 3% into Japan, about 16% into USA small cap, and about 25% into USA investment market index. Good. And okay, but now this all of the, can we summarize all of this data into something that people can understand? Yes, we can, with the chart that I was talking about. So this is the chart for the entire period Hey, it's me after a shower. I forgot to mention, and in the graph you don't see it, the name of the axis. So the horizontal axis is the volatility or the standard deviation. Remember what I told you before in the video, the standard deviation for the average returns of investments that last 10 years. And then on the y-axis, you have the average annualized return, I should say. That's the correct definition. Average annualized return. But yeah, back to the video. So not the one up to 2026, up to 2006, not the one from 2006 to 2024, but the entire thing. All right. This is the chart that I was talking about. This here, I did not draw it, but more or less this here, drawn like that. It's the efficient frontier for these portfolios. My current portfolio is standing here, completely out of the efficient frontier. My new portfolio is here. As you can see, it's not up here because I found these portfolios unreasonable on a logical point. I also have to, as I said, anyways, all of these results are completely wrong because the future cannot be predicted. So I also have to give some thought to it. Yeah, some practical aspects. So I decided to place my portfolio about here. If I look at the portfolio, at this graph with the combined portfolio of 30% from this period and 70% from this period, what I get is that my current portfolio is standing about here. My new portfolio is about here. Yeah. The efficient frontier is about here, and I'm standing here. So quite near the efficient frontier, but still in the reasonable realm. All right. So how did that translate into the investment portfolio spreadsheet? It translated like this. A lot more, uh, a lot more of emerging markets and a lot more small caps. No, a lot more emerging markets, not that much lot, but a lot more small caps, surely. Small caps are here with this fund and also here with this fund and also here. So I'm going really heavy on small caps. I also looked at small caps on a theoretical basis, not with data in the sense of what do small caps into a portfolio, how they are used, in which sense they could be used, and so on. Looking at some blogs and so on. I think Banker on Wheels, if I'm not mistaken, uh, or also early retirement now, probably not Banker on Wheels. Early retirement now has a posts about small caps. So maybe if you're interested, give a look at those. So I informed myself a little bit about the pros, cons of small caps, what they do to a portfolio and so on. So I decided at the end of the day to go with small caps. Um, so I know I'm exposing myself to a factor, small cap, and I decided to go buy with this. As I said, at the end of the day, the allocation is more or less the same when it comes uh, to geographical areas. So I'm still quite heavy on North America. At the end of the day, it's hard not to be heavy on the US because everywhere you look, be it an ETF on a third pillar, be it I don't know anything, everyone has about 50 to 70% US. If I do an analysis, it tells me go 100% on this. So it's impossible to do an analysis without having the US heavy in. If you start any analysis, you will see the US is always heavy. If I did not put here, if I did not put barriers to how much US I could have in my portfolio, probably, I did not test it, but probably I would get to 100% US. Simply because it, it's it's just unreasonable how the US went these past 10, 20 years. Really. And that's why it's extremely hard to do an analysis because you don't have a lot of data. That's all. And that's why the analysis that you do it's basically false. It's not predictive of anything in the future, but it's the best that I have. So that's what I can do. All right. Now, as you can see, we concentrated a lot on this part. What about this part? Well, this part did not go into the analysis because I did not want to overcomplicate things. So I only analyzed this part, actually, this entire part. Sorry. All right. What also, so at the end of the day, to summarize a little bit better, I'm going heavy on small caps, so I added two new ETFs, the FTSE All World X US Small Cap from Vanguard and the Vanguard Small Cap. Now, one thing to say, in theory, to make my portfolio more efficient on a tax basis, I should switch to dividing into from this ETF here into smaller parts of the ETF, just like I did for my other portfolio, for my other ETFs. So dividing it into emerging market small cap, Europe small cap, Asia Pacific ex Japan small cap, Japan small cap, and so on. But I did not want to do that simply because it's not that a lot of money, and I don't think it's reasonable right now to do that. Maybe in the future when I will have more money, I will do that. Right now, it's not that reasonable. And then, of course, Vanguard Small Cap, I took a US ETF. I also took a US ETF for this because it's cheap, but for this one, especially for the withholding tax on dividends. And then another ETF that you see here is the iShare Core Topics ETF, which you may not know about, but it's an ETF on the Topics Index, which is basically a total stock market index for Japan. And it's a Japanese ETF. It has a Japanese ISIN number. It's traded in yens. And why did I decide to use that ETF? Because from a for two reasons. From a tax purpose, I can also get back the withholding tax from Japan. So it makes much more sense for me to use a separate, not a separate, because I already had a separate ETF for Japan because I could not find an Asia Pacific with Japan included. But with this ETF, I cannot get back the withholding tax because the Irish government will just keep it. But with this one, I can. So that's the first reason. Second reason is that I found out that trading on interactive brokers on Japanese stocks is pretty cheap. Third reason, actually, which is because there is a third reason, is also the costs. Because the Japanese ETF, it's one third the cost of the European one. So, am I switching? No. I will keep my European one because it's the first time that I invest into a Japanese instrument. So, I will keep my old ETF. If this investment portfolio spreadsheet tells me that I need to invest more money into the Japanese index, into the Japanese market, I will just add the money into this Japanese ETF, but I will keep the European one. All right, another thing that changed is this part here. Unfortunately or unfortunately, I don't know, as you may know, we are getting into a period of pretty low interest rates, especially in Switzerland, where the Swiss National Bank decreased their rates by 0.5 points. That means that now the rates are 0.25. That also then means that these ETFs are basically useless almost losing money, I would say. If I go on Google and I look for, let's look for this one. If I go here and let's go directly, maybe on the iShares website. If I go here, you will see weighted average yield to maturity 0.20%. Actually, this is a lot better than what I have what I've seen earlier in the week. Let me check out this one also. This is almost too good in the sense that I will invest into it if it's actually like that. Yeah, okay. Anyways, it was about 0.09%. I wrote it here earlier in the week. I don't know what happened. Probably they rolled some uh, some some bonds. Not sure how it could have doubled in a week. Anyways, doesn't matter. Point is, it's 0.20% and the cost is 0.15%. So we are at about a net loss, almost a net loss. Well, before it was a net loss because it was 0.1%, but now it seems not to be the case anymore. So what I decided to do is basically go on this ETF, fully on this ETF instead, which is a bit more riskier if you want, but it has a lot of Swiss companies in it, and these are big companies, and the interest rates are very small, but it has about a 1% yield to maturity and average yield to maturity and still 0.15% of total expense ratio. So it's a little bit more reasonable. So I know that I'm increasing a little bit the risk, but I mean, that's the only option. There is not many other options simply because if these costs would be zero or almost negligible, I would invest in these ETFs, even if their return was close to zero. It's fine. Problem is that I'm afraid that if the returns, the yield to maturities of these bonds go lower, then the costs will start eating into my savings. And that's a problem for me, of course. So I'm keeping these two ETFs as they are right now. I'm just increasing the position on this one. And then I'm also increasing the position on these two US dollar bond ETFs, which are the iShares, the I bonds from iShares, which are the interesting ones that expire in 2027, and I wanted to keep them to see also how they go. I also added these liquidity fund, this money market ETF, money market mutual fund is not an ETF because I thought I wanted to use it, but also this one, because of its costs, it's almost at zero. It's about 0.2%, I think, the return now, including costs. Um, and it's basically the same as the one that gives my bank right now. So, yeah, I don't see any reason for me to use this fund at the moment. It also has a really high cost. So with the extremely low interest rates in Switzerland, it's fairly difficult to use this fund. Then one thing also is that the comparison between the current stock allocation and target stock allocation. As you can see, I decreased the US a little bit, but as I already said, it's quite hard to decrease the US that much. But I managed to decrease a little bit Europe because from the analysis it shows that Europe is a good market in the sense that it's fairly stable, but it's also kind of negative in that sense. In order to substitute this portion of Europe, what I did is increase a little bit Japan and increase the emerging markets and also a little bit Asia. Then, when it comes to some technical stuff of the spreadsheet, I added debts, a line for debts. I decided that it's better this way. The debts, my debts are basically the taxes that I have. So that means that these cancels out. Before I was summing up only this part of my portfolio. Now I decided to include also the taxes into the sum as part of money that I have, and then subtract it immediately after with a line for debts. And also I added this one, pillars taxes. So these are basically taxes on tax deferred accounts, which are the second pillar and the third pillar. And that's basically it. Those are just technical stuff. So as you can see here in the summary, it's different from what it was in 2024. Also, this spreadsheet is in the description if you would like to download it. Both the 2024 and the 2025. The 2024 is also available on the review of 2024 video that I did. So as you can see here, there is a line for debts, a line for tax deferred accounts, and then a tax for the first pillar. I think I talked about this one already. This is just a little bit of kind of a joke, a little bit to calculate my pension, but it's not included in my net worth. So as you can see here, the sum is up to that number. It's not included because it's not money that I have, it's not money that I can spend, it's not money that I want to calculate with. So it doesn't make any sense right now to use that number. So that's basically all I wanted to cover in this video. If you have any questions, you can leave them down in the comments. I encourage you to give a like to this video if you liked it, and subscribe to the channel if you're yet not subscribed. And I will see you probably in the next video, which maybe will be in 3 months, when I will do the review of the first quarter of 2025. And I will see you guys in the next video. Ciao, ciao.